Hello, a very good morning and good night to all of you here. Welcome to ABFER, the 8th annual conference, and welcome to the corporate finance track session. My name is Angie. I'm from Nanyang Business School, and I will be the session chair for this morning's session. Okay, today we have a very big, interesting lineup of papers in this morning session. So how will this work? Each paper section will last for about an hour. We will have 25 minutes of presentation time, 20 minutes of discussion by the discussant, and then after that we will have 15 minutes Q&A. After that, we will have a 15 minutes break before the next paper. Okay. For the Q&A, you can also put in your comments or chat questions in the chat function. Okay, just the chat function, because that's easier to monitor. All right. Without further ado, let's welcome Tao Shu from Chinese University of Hong Kong. He'll be presenting to us about dividend policy in the era of big data. And the discussant will be Christina Chu from University of UPenn. Okay, Tao Shu, the floor is yours.
Okay, thank you, Angie. All right. It's great to see everybody. ABFER conference is one of my most favorite conferences. And so it's great to see a lot of friends in here. And I really hope the travel situation will be back to norm so that we can have on-site conference in Singapore soon. Okay. So this paper is joined with Yancheng from Hong Kong UST and Shujing from Tongji University. I think they're also watching the presentation now. Okay. So the paper is about alternative data. With the great advancements in technology, we now can obtain or process alternative data or big data, which are impossible to be collected or used by traditional methods. So the finance literature has looked at alternative data, mainly in the setting of asset management. For example, people have looked at the seeking alpha or customer activity measured by mobile devices, and that all look at electricity usage. Actually, these days, over half of the global hedge funds use alternative data for their trading strategy. So in corporate finance, to these days, we only have limited evidence about how alternative data can impact the corporate policies. I think the key here is information asymmetry, which can impact various corporate policies. Basically, outside investors know less than corporate insiders, and that can affect many aspects of companies' operations. So this alternative data can help outside investors close their information gap relative to fund managers and therefore reduce information asymmetry. So in this paper, we examine if alternative data can affect corporate policies through alleviated information asymmetry. So the data we look at is this satellite-based parking lot traffic. This is an example where this is the outside of Walmart store on certain dates in 2016. And as you can see, the blue area is the parking lot outside Walmart. And the dots, the circle dots are cars. So if you can count the number of cars, it's 129 at this point. So the satellite data, it has always been here, but it's just that the vendors have recently developed techniques to first figure out the boundary of the parking lot and then count the number of cars. So in this paper, we look at staggered releases of satellite-based parking lot data by two vendors, RS Metrics and Orbital Insight, which includes 142 public retail firms. The releases are during 2011 to 2017. Christina, the discussant, wrote a novel paper showing that the satellite data indeed contains value-relevant information and improve information transparency, and then help outside investors monitor managers. So basically, this satellite data can help or can be considered as a mechanism of monitoring. So why do we look at dividend policy? There are several reasons. First is, of course, is a major corporate policy. And second is the three major dividend theories these days are centered on information asymmetry, so which is a unique setting to test the impact of satellite data. So that's why we look at how dividend policies change after the release of satellite data. So our main finding is we conduct a difference in differences analysis, and we find that retail firms substantially increase their dividend payout after their satellite data is released. And interestingly, the increase is concentrated in firms with poor investment opportunities. So I'll discuss the three models, but this is consistent with the outcome model where because of agency problem, managers tend to misuse their company's funds. So investors push for dividends to reduce the amount of free cash flows and reduce the agency cost. And we also conducted further analysis and also find consistent evidence consistent with outcome model. Basically, the effect is stronger when firms have more entrenched managers, less severe financial constraints, or higher ownerships of sophisticated investors who can better use or push for dividends. So I'll explain this results in detail. And we also find that firms indeed, they finance the dividend increase by cutting their investment. And interestingly, they cut general investment, but the good investment, we look at R&Ds, remains largely the same. So there's no decrease in R&D. So the data is, there are two vendors, RS and OB. RS is the first US data vendor that releases the parking lot traffic data in the first quarter of 2011. And then the major competitor is OB. They release similar data, although the two vendors provide slightly different services, actually quite different services, but all based on the same type of data. So it includes the daily store and firm level parking lot data counts and parking lot utilization for US retailers. So June 2019 examined the data, satellite data releases, and they find that indeed the releases increase the stock price efficiency of the retailers and reduce the profitability of insider trading and also reduce investment inefficiency. So actually, it's like an additional mechanism of monitoring. And a couple of follow-up papers also find that indeed satellite data contains value-relevant information about firm performance. So these results, we verify them in our sample too, because our sample is larger than these papers. And in our appendix, you can find the detailed results. So these are the events, 142 events. So you can see the largest number occurred in 2016 in the summer of second quarter, where a lot of firms starts to have to be released. So we did a different analysis. So the control firms are those in the same industry but not covered by either vendor. We also dropped the first 2 years from IPOs and our other standard data sets. So we have about 6,000 firm years, about 1,200 for treaty firms and 5,000 for control firms. We use two main measures. Dividend yield is the dividend divided by equity, market value of equity. The average is about 1.09%. And then we have dividend payout ratio, which is dividend divided by earnings. So this is about 21%. In some robustness tests, we also use a dummy of paying dividends. About 43% of our sample firm years pay dividends. So let me quickly talk about the three theories. So based on M&M, dividend should be irrelevant in a frictionless world. But in the real world, firms actually follow very carefully designed their dividend policies. And dividend is puzzling for U.S. firms because if you pay dividend, then shareholders pay higher taxes because they pay the tax rate is higher than capital gains. So there's three major theories of dividend. The first is outcome model, as I just mentioned, because of agency problems. Managers may misuse their firm's funding. So investors will push for dividend, which can reduce the cash flows and reduce agency costs. So this should be concentrated in the firms with poor investment opportunities. So this investment opportunity or poor investment opportunity is the key in this model. And then if this model is true, we should predict an increase in dividends for event firms because satellite data provide a real-time or very timely value-relevant information so that outside investors can better monitor the managers and detect bad investment and push for a dividend. The second one is the substitute model proposed by, for example, Mayer's 2000. It's also based on agency problem, but a different channel. So here it says because managers may misuse funds, so sometimes managers will pay dividend to establish a good reputation of not misusing corporate funds so that they can raise funding in the future at lower cost. So in this case, we should find a decrease in dividend after satellite data release because satellite data reduces information asymmetry, so there's less of a need for managers to use this costly commitment of not using misusing fund. The next one is the signaling model proposed by, for example, Grulin et al. 2002. It says because of information asymmetry, if you are a high type company, you want to pay dividend as a costly signal to signal good prospects of your company. Exactly what kind of good prospect, there's still debate. For example, is it good cash flow or is it a lower risk or lower discount rate? But the overall story is about signaling a good prospect. So this model would predict decrease in dividends because there's low information asymmetry, so less of a need of costly signaling. So we conduct a difference in diff regression. This is the main results of our paper. Post-release is a dummy variable for firm years after the release. And we control for a broad set of firm characteristics, which might also affect the dividend policy. We find that the coefficient of post-release dummy is significantly positive. With control, without control, this is actually very robust. And the magnitude is also pretty large. For example, dividend payout ratio, the effect is 11% after 11% increase after the release. And this is about half of the average dividend payout ratio of our sample firms. And then we conduct a pre-trend analysis. So basically, we want to address the identification issue. So these are three dummies. The first one is the period before the event, minus the year -2 to -1, and then year 0, which is the release year, and year 1, and then year 2 onwards. We find that there's no differential trend before the event. This coefficient for pre-trend is insignificant, but there's a large increase after the event, and the magnitude seems to increase as time goes by after the event because investors will more and more have more and more access and usage of the satellite data. So if you look at this visual, to put it visually, there's a little trend, slight increase before the event, but insignificant as we find. And then there's a large jump after the event from year one. This result, as I just mentioned, is very robust. We did, for example, a pseudo firm or pseudo event analysis. We choose firms from treated firms or firms in the same industry but not covered by vendors as a pseudo event firm, or we move event period backward by 10 years, or we construct treated firms in different ways. Or we only use treaty farms without by throwing away control firms, and we also use alternative dividend measures such as scaling dividend by assets, or we use a dummy variable of paying dividend. So basically, the results are quite robust in all these large number of tests. So next we conduct more analysis on the outcome model, where the key is a poor investment opportunity. Because if it's a good investment opportunity, then investors will be willing to accept a low dividend to support a good investment. So if it's outcome model, then the results should be stronger for firms with poor investment opportunities. We measure investment opportunity or growth opportunity use two measures, sales growth and Q. So this is the interaction. Post-release, interact with a dummy of low sales growth. And we also use a dummy of low Q. As you can see, the coefficients are significantly positive, suggesting that the increase is much larger for low sales growth or low Q firms. So this is also consistent with the outcome model. And if you look at the post-release dummy for the dividend payout ratio is insignificant. So using this ratio, basically the results actually concentrate in the firms with low investment opportunities. And then we conduct more analysis. We first look at managerial entrenchment, because if managers are entrenched, then improved monitoring should have a larger marginal effect. And then we look at financial constraints, because in this case, the managers will have more flexibility to waste resources. So in this case, we should find a stronger marginal effect on of the satellite data. And next, we look at sophisticated institutional investors, because this data is mainly used by institutional investors. So the user base comes from hedge funds, investment bankers, and analysts. So various people, but they're not definitely not individual investors. So if a company is held more by institutional investors or sophisticated institutional investors, then we expect the result to be stronger. And we find it's indeed the case. We use E-index and ATI measure to measure managerial entrenchment, and we find that indeed the effect we document for post-release and low sales growth or low Q farms is indeed stronger when the company has a high entrenchment. The results are similar when we use a Q as the measure of growth. We use three measures of financial constraints: KZ index, HP index. Basically, it's a size and age dummy, size and age of a company, and WW weighted and Wu index. These are three popular financial constraints measures, and the results also show a stronger effect on financially constrained firms. And then we have institutional ownership. We use high fund, hedge fund ownership, and also monitoring institutional ownership. This is based on the measure of monitoring institutions based on somehow Emery Bush's classification, and the results also show that with the higher sophisticated ownership, the results are stronger. Finally, we look at exactly what's the mechanism or the channels through which the company pay dividends. If it's the outcome model, then the dividend payout increase should come from reducing the bad investment. So we look at investment versus financing, external financing. We also try to distinguish between general investment and good investment. So general investment, we simply measure by sales growth, by asset growth. This is also a popular measure of investment. Existing literature shows that general investment actually is followed by lower future stock returns. Of course, there's still a debate about why we have low returns after general investment. There's a risk and also agency explanation. But people generally think, or the literature generally finds that R&D is sort of a good investment because it's followed by good returns and also good operating performance. So we first look at financing. We look at the short-term debt and long-term debt and equity raising. And if you look at the three coefficients, they are all of them are insignificant, and the magnitude is quite small. So which means the firms do not raise external funding to support the dividend increase. But if you look at the investment, is a very different picture. So the first three columns, we look at asset growth, which is the general investment. We also look at this should be the current asset investment. Sorry, and this is inventory. Okay, so we look at the three investment measures, and they are significantly negative, which shows that firms indeed try to finance their dividend by cutting their general investment. But if you look at R&D column, their coefficient is insignificant, which means there's no decrease in R&D. Actually, the coefficient is slightly positive, although insignificant. So this is consistent with also with the outcome model, where the companies cut their poor investments or bad investments to finance the increase to pay more dividend. So let me conclude. We examine how alternative data affect corporate policies. We find that firms significantly increase their dividend payout, and especially for firms with poor investment opportunities. We find a larger increase in dividends for firms with greater managerial entrenchment, less severe financial constraints, or higher sophisticated institutional investor ownership. This is also consistent with the outcome model. And also the event firms finance the increased dividend by cutting overall corporate investment, but not R&D, which is considered good corporate investment. So I want to clarify that even though these results support the outcome model, they do not necessarily veto the other two models because different models may work, in different contexts. So I think the bottom line is our model shows that the outcome model plays a very important role in shaping a company's dividend policy. And finally, I think our paper is one of the contributes to the growing literature on alternative data and corporate finance. We show that the usage of alternative data can have a large impact on corporate policies. So I think this is this is an area, the big data and corporate finance can be a very interesting area of future academic studies. Thank you. And I'm looking forward to Christina's discussion.
All right. Okay, so thank you for to the conference organizers for the opportunity to discuss this very interesting paper. This paper examines dividend policy in the era of big data. The setting of big data is really fascinating to me, as you can tell from my prior work. I also like that it reflects the current landscape of information used by investors and information that affects firms as well. And this paper examines something that I haven't thought very much about in my prior work. And my favorite type of paper to read is one where I learn something new, and I truly learned a lot from reading this paper. So thanks to the authors for writing this really fascinating paper. So the paper studies how big data availability affects corporate policies, and in particular, dividends. So I really like the motivation for this question. And one reason for that is that the answer to the question is not immediately obvious to me. The paper does a good job establishing that the answer to this question, even though it's theoretically motivated, is ultimately an empirical question. And the empirical analysis here is very thorough. My suggestions are going to center on how to really nail both the setup and the landing of this paper. In other words, I have some suggestions for how to frame the hypotheses, as well as some suggestions to strengthen the empirical analysis. So it looks like both Tao and I have lifted the same satellite image from the paper. This is from figure 1, a satellite image of Walmart's parking lot. And we see that Orbital Insight RS metrics, they're providing aggregated data from these satellite images where they extract the number of cars in parking lots from stores all over the US to sell to investors. Now, this type of aerial surveillance is not new. Interestingly enough, if we look at Walmart, Sam Walton, who is the founder of Walmart, he used to fly around in his aluminum plane, and he liked to do this aerial surveillance. He would fly around and across the middle of the US and scout for new Walmart locations, drop in on his stores, say hello. So there's quite a history with retailers and aerial surveillance. Now let's fast forward a little, and we know that satellite images are not new. So what people used to do before the satellite image data providers came to be was that they would hire a hedge fund analyst to go into these stores to use these physical clickers and count the number of people entering the stores, drive around the parking lots, see how many cars are there, for example. So now the modern way to do this is to go to Orbital Insight RS metrics. They've use machine learning to extract the number of cars in the parking lots, and hedge funds are very happy to fork over a lot of money to get access to these data sets. Okay. So this paper does something very interesting. It shines a light on Walmart. So instead of looking at the hedge funds who are buying the data, it then looks at how that affects Walmart's corporate policies, in particular dividend policy. Okay. So the work that I've done previously basically finds that the availability of alternative data improves price informativeness, and that's because it reduces the information asymmetry between firms and investors, and it improves the ability of investors to monitor managers because price informativeness is improved. Now, this paper looks at something different. Do dividends increase? Is there no change in dividends? Do they decrease? And I believe this is quite interesting. I'm going to summarize quickly the 3 theories of dividend policy, although Tao already did a very nice job of that. The outcome model, where investors push managers to pay dividends, especially in firms with poor investment opportunities. That's the Laporta et al. 2000 finding. Dividends and governance are complements in addressing agency issues in the outcome model. Then we have the substitution model, where dividends are a substitute for effective governance in addressing agency issues. And then the signaling model, where managers use dividends as a costly signal to convey private information about the future prospects of the firm. Now, something I want to point out is both the substitution model and the signaling model predict that big data availability substitutes for dividends. So in the substitution model, dividends are a substitute for effective governance. And in the signaling model, dividends are a substitute for publicly available information about the future prospects of the firm. Now, an issue with the signaling model is that the empirical evidence in the literature, and I've just lifted this quote from D'Angelo et al. 2009, is that a challenge facing the signaling model is that it must explain why firms with little need to signal typically make the largest payouts. Okay, so that's just one issue with the signaling model. And it's also true that, again, the predicted change in dividends is a decrease in dividends in this setting, in the big data setting, due to both the substitution model and the signaling model. So I've taken this from one of my favorite TV shows, Stranger Things. What if the paper had instead found that big data availability is associated with a decrease in dividends? So they find an increase in dividends, but what if we're in this upside down world where everything doesn't make sense? We find that in this dimension, big data availability is associated with a decrease in dividends. Now, can the paper distinguish between the substitution model and the signaling model using this setting of big data? Now, I think that's going to be challenging. Could the paper instead consider two models only or just two hypotheses that may be consistent with multiple models? In the outcome model, investors push managers to pay dividends, especially in firms with poor investment opportunities. Again, dividends and governance are complements. And then we have the substitution model where dividends are a substitute for governance or publicly available information. Now, looking at two models only might be nice. Combining the signaling and substitution model would be nice because it would focus the motivation of the paper, avoid some issues with the signaling model, such as firms with little need to signal typically had the largest dividend payout, and it would avoid issues if we were instead in the upside down world and the paper found the opposite result. Now, I know that that comment is a little bit unfair because I believe that if the paper had found that opposite result, they would have done quite a bit of work to try to distinguish the substitution model from the signaling model. But the truth is that information asymmetry and corporate governance go hand in hand. And in this setting, both information asymmetry and corporate governance are improving. So in that sense, it will be very, very difficult to distinguish between the two. And I'm not sure that this is the right setting to try to distinguish between the substitution model and the signaling model. So the outcome model, where dividends and corporate governance are complements, investors push managers to pay dividends after the availability of satellite data. I would like to push the paper to examine how this happens, provide more of an explanation about how satellite data availability helps investors to push managers to pay dividends. So one example that I would ask the paper to consider is potentially activist investors. This is an article from the Wall Street Journal in January 2018. This is about D.E. Shaw, a hedge fund that invests in Lowe's. And Lowe's is a home improvement company, a competitor is Home Depot. And it seems like D.E. Shaw came to the meeting with Lowe's armed with some satellite data, including the satellite data of Home Depot, and used this data along with US Census data to tell Lowe's that they're underperforming, that they were not attracting enough customers. So activist investors do seem to be using big data, satellite data in particular, and this is one channel through which they might be influencing the corporate policies of the companies. So they often pressure management to increase share buybacks and dividends, and this channel is testable. So the paper could actually look at item 4 of Schedule 13D to determine if activists actually pursued a change in dividend policy. Because item 4 is the purpose of the transaction, and part E says if there's any material change in the present capitalization or dividend policy of the issuer, that must be disclosed. Okay, so maybe the paper wouldn't find something like that, but perhaps it still is through the channel of activists because increases in dividends are firms attempting to deter activists. So one example of that is this is again lifted from Gonchev et al. 2019. EMC, they started paying a dividend in part to distract activist attention from its large cash balance. And very recently, just a few months ago, Kohl's, again, an article from the Wall Street Journal, this headline says Kohl's is way ahead of activist investors. The retail chain said it would restart share buybacks and dividends during this new fiscal year. So firms could be trying to deter activists by paying more dividends, and activists are now armed with this alternative data. So now I want to move on to the empirical tests. The paper uses a generalized difference in differences specification, and that's on the top there. We have the dependent variable, dividends, being regressed on post-release, right? That's the difference in differences variable of interest. And then we also have firm and year fixed effects. Now, just so that everyone's on the same page here, I'm going to talk about the simple difference in differences specification, which I have on the bottom here, where we have the dependent variable, dividends, being regressed on post, an indicator variable for treat, if it's treatment firm, and then post times treat, right? So that beta 3 is going to be that difference in differences coefficient of interest. So the reason that we don't have the post and treat main effects here is because they are subsumed by the firm and year fixed effects. Something that readers should know, and this is going to become important in a second, is that post-release up at the top is actually equivalent to post times treat, meaning post-release is set equal to 1 only if post and treat are both set equal to 1. Now, why is that important? Well, that's important because that is true, the main effects interacted with the cross-sectional variables are actually excluded from some of the regressions in the paper. So I just want to caution the paper to make sure that you include the main effects, post times treat, interacted with low growth. This is just one example, and included in the regression. So in the bottom equation there, I've inserted in red the interactions that have been excluded from the model, but should be included to make this a well-specified model. All right, also the cross-sectional tests. Okay, so my view of cross-sectional tests is that they should support the main prediction. And the paper does a really good job of this in some respects, and then there's some other stuff that I think distracts from the main message. So what I like is section 5.1. Section 5.1 finds that low growth firms experience a greater increase in dividends. That supports the outcome model, right? Where investors are pushing firms to pay dividends, especially in low growth firms, because that's where that, they should not be investing that, they should be paying dividends. Now, my issue is section 5.2.1, which I think could be clarified a little bit more. It finds that low growth firms experiencing a greater increase in dividends, that result only exists in high entrenchment firms. So what's going on here is that the tests are combining two different cross-sectional variables, investment opportunities and managerial entrenchment. And so I've copied equation 3 on the bottom there. You can see there are a lot of interactions, and also keep in mind post-release is actually post times treat. So that's a quadruple interaction. And then we're also missing some of the main effects interactions in there. So this is actually a longer equation than is what is on the slide. So this is a little bit hard to interpret, okay? So one suggestion is to perform the cross-sectional test one at a time to clarify what we actually learned from this test. So I've crossed out the triple interactions here, and I've circled the interactions that I'm interested in. So see if we can just focus on one cross-sectional variable at a time instead of stacking them all and getting these quadruple interactions. Okay, section 5.2.2 finds that low growth firms experiencing a greater increase in dividends, again, only exists in firms that are not financially constrained. So once again, same suggestion, performing the cross-sectional test one at a time, I think would really help the reader understand what we've learned from each of these cross-sectional tests. But I also struggled to understand how financial constraints help us understand and support the outcome model. I think it's clear that financial constraints will matter in terms of the level of dividends, increases in dividends, but it's unclear how that helps us distinguish from the outcome model and the substitution model. So I think there's more clarification there that's needed. And if there is no clarification, then I think the paper should consider whether this test actually is worth the real estate that it takes up on the page. And again, need to include the interactions of the main effects, post and treat with each cross-sectional variable there. Okay, so other suggestions. I think the paper does a good job acknowledging the selection concern, right? Data vendors may time the release of data based on firm characteristics. Why did they release the data in the first place? Of course, investors should have been interested in the data, and that's why they began to release that data. Those firm characteristics may also be related to dividend policy. So the paper acknowledges this point, but I think it goes a little too far in saying that its tests can actually address that concern. So assessing the change in the difference in differences coefficient after adding firm characteristics as a control, that should not address the selection concern. Also with firm fixed effects, there's going to be very little variation in the firm characteristics within firms. So, I think it's good to add the control variables, but I think the selection issue is still there. It's just going to be hard to address. Also, assessing whether the pre-treatment trends are parallel also does not address the selection concern. Very necessary validation test to do. It assesses whether this control group is an appropriate control group, but selection still a concern. I don't really know how to get around this, but I think it's just something to acknowledge. I've also taken the liberty of pasting some notes from table 1 in here, and we have different dependent variables with different number of observations. So the paper makes clear that div divided by earnings, there's fewer observations there because it's set to missing when we have negative earnings, negative net income. So that makes sense to me. But what I wasn't clear about was why there are 6,323 dividend dummy variables available, but somehow there are 2 fewer observations when we need market value. So, why are these firms without any market value being included in the sample at all? Just something to clarify here. And then I think there might be a typo here because the paper basically compares this triple interaction coefficient 0.598 to this other triple interaction for low entrenched 0.099 and says that the increase in dividend yield is 0.598 percentage points higher for the low growth firms than for high growth firms. Or I think I might have copied it wrong. High entrenchment, low entrenchment. But I think this actually needs to be this needs to be 0.499 because we're comparing the difference between these 2 coefficients. And then we don't know if they're significantly different. So there needs to be a test for whether that 0.499 difference is significant. Finally, this is not a suggestion, but it's a compliment. I really like table 4, the alternative sample test. I think with this type of the satellite data releases, it's really nice to think of that it's like a staggered release of data, but there's so much information out there. There's so many other data sets out there, right? I consider just one other data set in my prior paper, online consumer transactions, there's credit card transactions. There's so many different types of data out there that I think it's hard to say that this is truly a staggered release of data, but what the paper does a nice job of is saying, okay, well, let's consider all these other different control samples. Let's even do a test without any control sample, and let's see if our results still hold, and they do. So I appreciate that the paper did that and acknowledged that type of concern. So in summary, I think this is an incredibly interesting and thoughtful paper. It shines a light on an important topic, which is dividends in the era of big data. My suggestions are to focus the predictions and to consider the role of activist investors, right? This could really help you support the outcome model. Activists could be pushing for more dividends, or companies could be increasing dividends in order to distract the activists from coming at them. I would like the paper to consider including the interactions with the main effects post-entry that are currently excluded from the specifications, to refine the cross-sectional test, maybe do them one at a time to help readers like myself. When I see too many interactions, I get very confused. And I wish you the best of luck with the paper, and I look forward to seeing it published someday soon.
Thank you, Christina. Tao, do you want to comment briefly on Christina's discussion? And then after that, to open the floor for discussion to the attendees for Q&A, because there's quite a lot of questions actually. So
okay,
just briefly.
Sure. Yeah. So thank you very much, Christina, for the great discussion. Apparently, thank you very much for reading the paper very carefully and for the sharp eyesight. And we are actually revising the paper, so we will incorporate these comments into the revised version. I especially thank you for the suggestion on how to test how firms, how these push firm to increase their dividends. We have been thinking about this for quite some time, and actually looking at the things such as the voting records, but because of data issues, we have been unable to do much. But we'll definitely follow your suggestion and look at the test you mentioned. So it's very, very helpful. Thank you.
Okay, thank you both. Now we open the floor for the participants to ask questions. So the panelists will actually are able to ask questions directly. For the attendees, you will need to raise your hands to ask questions, and then I think Chule or they will activate your mic and the video. Okay, so there were quite a few questions in the chat just now. So maybe I can ask Johan to first ask his question. Johan, are you around?
Okay. Hey, yes. Hi, Tao.
Hey, Johan.
So you're looking at dividend payments. I find it surprising that you're not looking at share repurchases along with dividend payments, because share repurchases have become quite prevalent and probably even dominant method of payout over the last 20, 30 years. So I'm not sure why you're only looking at dividends. This is cash dividends, right? I assume. So I think you should also look at share repurchases. Okay.
Yeah. So somehow on my side, the picture is frozen. I'm not sure what happened. Can you see me or hear my voice?
We can hear you.
Okay. We did look at repurchase in our paper. We focus on dividend because there are very clear theories about dividends, but repurchase we don't have and all the dividend theories are centered on information asymmetry. But repurchases, the factors people consider can be different from dividends. So we did look at repurchase as in one of the tables, and we find some weak evidence that companies also increase repurchase, but the results are not as strong as the dividend increase.
I guess what I'm suggesting is that maybe you can add those two together to say something about payout policy. But I understand your concern.
Yeah, we can do a test by adding them together. So I think to see if the overall if they I believe if I added the two together it will be increased too. Yeah. Mm-hmm.
Okay. How about Ru Hong? You have a question as well?
Yes. Hi.
Hey, Ru.
Hi.
Hey,
yeah.
I always messed up his first name. His last name is a very rare Chinese last name. Yeah, go ahead.
That's right. Yeah. Good to see you. So my question is how about the retailers that focus on online shopping, like Amazon? So the satellite pictures doesn't really that relevant for their firm activities, and even for some companies like Walmart, they sort of have a big shift from offline to online businesses. So this is also related to my second question about the control group. So what are the control groups in your different diff? So how about these firms in other industries that the satellite information are not so relevant, like for example Facebook, and you can't really use the satellite information. So everybody work from home, for example. So are these firms in your control group or not?
So the control groups are the retailers doing the same businesses.
Right.
For example, say supermarkets, but not covered by either vendor. So there are the same type of retail firms, but without parking lot data being releases. Yes. So about your first question, I agree that online shopping can add noise to the effect of satellite data. But these days in the US, I think Christina's paper has provided this evidence, and we have confirmed in our sample too that the satellite data of parking lot traffic indeed can predict earnings surprise and also affirms future performance. And also a couple of follow-up papers also show that I think we also find that hedge funds after the release of satellite data starts to use the data in their trading.
Thank you.
Mm-hmm.
Okay, I'm going through the chat first. So then the attendees, we have Ziman. He has a question.
So
Hi,
where
Dr.
can I see the question?
No, it's okay. Zuman will ask the question directly in the video. Yes.
Oh, okay. I see.
Thank you so much for your presentation. I'm curious on the post-release variable, because if firms may have a lot of store across US, so like Walmart says, there's lots of store across US. Do your post-release variables means all stores or Walmarts are released at once, or is it just a portion of stores that release? So if this is a portion, do you have the statistics on the earnings ratios of release stores over the whole firm? Because I'm curious on if this is big enough to influence the whole corporation payout policy.
I think the release is at the firm level, which is they release the data for the whole company. So the big picture is this: the satellite data image has always been there. So the satellite data is not a new technology, because we have satellites surrounding the Earth from a long time ago. But these two vendors actually they developed a technology to identify the parking lots for each retailer's stores, and then figure out how to calculate the number of cars. And they also use some mechanisms to figure out, for example, to attribute the parking lot traffic to certain retailers if there are several stores located together. So the release is the firm level, and is mainly initially for hedge fund managers to trade on these firms.
Okay, got it. Thank you.
Thank you.
Okay, we have Chief next.
Yeah, can you hear me?
Yes, we
Hi,
can.
Tao, this is Chief. Very nice paper, interesting paper. I had a question that actually Christina mentioned in her discussion. That's how the data vendor decide to initiate coverage of certain firms, right? I think I don't know anything about it. My most reasonable guess will be it's driven by investor demand, which suggests that something's changing around the time when those firms get satellite covered. And presumably those firms has grown fast enough, become big enough, and player in this retail industry, such an investor would like to know their parking lot capacity. So is there any way to dig deeper into the decision of data initiation and find whether there are some quirkiness that you can explore to extract more randomness in it?
Yes, I actually I missed the first part of your question. I think you're talking about selection issue. Maybe the reason that a farm starts to
how they decide to initiate the coverage.
Okay, yeah. So this is a good question. So we acknowledge in the paper that this staggering release is not a silver bullets against endogeneity or omitted variable issue. So that's why we look at the pre-trend, and at least that these firms don't seem to have a very different, where they have similar trend before the release. But I agree that we did not fully address we did not fully address this issue. I think the cross-sectional analysis also helps, because that's, for example, the poor investment opportunity is particularly relevant to the outcome model. So I think it will be helpful to as Christina suggested, to look at how firms are pushed, or how investors push these firms to pay more dividends. That can also help address.
Is there an intensive margin you can exploit, like the cloudiness of some key areas? Abi Rup have a paper on that.
Right. I know his paper. I see your point. So maybe conditioning on satellite image data is available. Maybe sometimes the quality of the data can be affected.
Right.
We can. I'm not aware of such data in our setting, because our data requires, maybe you require to have cloudiness or something that's for the store locations of a retailer. That will be more difficult to get. But we'll think about it along that line. Yeah, that's a great suggestion.
Thank you.
Junko has a question.
Okay, so it's a very good paper, Tao. So one question about those data. So what kind of information this satellite picture can convey? So does it contain some information about firm's future earning? Because you show that actually the firm pay more dividend by cutting investment, right? But also no change in those borrowing and then equity issuance.
Mm-hmm.
So I'm wondering whether those earning in the future, because without earning, they cannot really maintain their long-term earning because dividend policy is very sticky, right? So is there any way you can show that some long-term earning change because of those satellite the picture release? I'm not sure whether there is some correlation about those information contents.
I see. We did not look at operating performance after the release. We can definitely look at that. What we did some tests in a paper to look at if the traffic growth can possibly predict future earnings. That's largely to test if this satellite data is informative of firms' fundamentals. Yes. So about earnings, I think our the increase in dividend does not necessarily requires the earnings increase, because you can have the same earnings but a higher payout ratio. But overall, I agree that if agency cost is reduced, that should lead to better earnings in the long run. Yes.
Thanks.
There is a question from Jongmin. Not too sure whether she can raise her hands. If not, I'll ask on her behalf. Okay, given that firms smooth out dividends over time based on the Lindner's model, it is a bit surprising to see a sudden increase in the first year. Do you have any explanation for that? Or is
yes, we actually, the magnitude is larger than we expect. As I just mentioned, the increase in dividend is about half of the average dividend payout ratio. So which indeed shows that this effect is, I think, economically significant. I think our the outcome dividend model is actually sort of independent of the dividend smoothing, which is based on a different mechanism. So my guess is that firms will, after the event, will gradually achieve a higher level of smooth earnings. So basically, the earnings will still be smooth, but at a higher level after the event.
Okay, thank you, Tao. I think any more other questions from the floor? Can I just ask one last question?
Sure.
Okay,
Yeah,
you use R&D. You use R&D as an indicator of a good investment. So for retailers, what kind of R&D do they do? I mean, why would
they do R&D?
Oh yeah, and why would it be a good investment for them? Yeah, so I mean, I understand that you need to have a metric for good investment, but R&D seems a bit off for retailers at least.
Yes. So so these days, I think all types of companies do R&Ds. So these R&Ds, for example, the retailers can also try to make their operations more efficient. I honestly, I don't know the details, but I think they can use R&D to invent, for example, better inventory management system, which is a very important aspect of these days competition among investors. I have a patent paper where I looked at a bunch of patent applications, and surprisingly, a lot of firms you would think a very, very low tech company, they do a lot of innovation. For example, the company is producing sprinklers, garden sprinklers, and they do a lot of R&D to try to improve how to scientifically sprinkle, save water. Yes, so retailers, I think they also do R&Ds.
Okay, thank you, Tao. I think there's no more questions from the floor. Just 9:30, at least in Singapore time. We'll take a break and then come back in 15 minutes time at 9:45 for the next presentation. Thank you, Tao, and thank you, Christina, and thank you for all the participants.